marketing leaders need to stop saying we don't have enough budget. We don't have enough budget was an appropriate thing to say when all that mattered was effectiveness. It didn't matter how much we spent. Most marketers didn't even report on the spend. It was just, we did content syndication and we won 6 deals and we got 180K ARR. And the amount of money that was invested there or the amount of SDR time or that stuff wasn't even included in reports in 2018. And now, given where we are, we need to be combining not only is this program effective, but how much did we spend on it? And then what is the estimated ROI of these things? And we need to have not only it generates revenue, but it does it at an appropriate return on investment that's set within the guardrails of our business planning process. We need to get out of the idea of I don't have enough budget, and we need to get into the idea of we need to fundamentally improve our unit economics. I talked a couple of weeks ago about the Gartner CMO spend survey, and then I posted with some more context. I was able to re-listen to the things that I said and then continue to explain it more in the text copy of my LinkedIn post from last Friday. And it ended up because the Gartner survey and the publication around it, as well as just what I hear in the market, the consistent sentiment that's being perpetuated, whether it's from CMOs or from vendors and analyst firms or both, is the I don't have enough budget conversation, specifically from the marketing leader or marketing department. I don't have enough budget. And I finally said it clearly on Friday, is that it is not a problem about having enough budget. The actual problem is unit economics. The actual problem is that in the amount of money that you currently spend, you do not get an appropriate ROI against the business goals. And so I was trying to do this before, but I didn't have enough time. So I'm going to try and do this on the fly to explain it, but bear with me. A slightly below average company that we would analyze at Passetto would get 50 cents in revenue for every dollar that they spend on marketing and SDRs combined, which means that at a 20% win rate that they're getting close to $2 in pipeline for every dollar they spend on marketing and SDRs. Which means that if they spend $10 million on marketing and SDRs, they're going to create $20 million in pipe. So that becomes the core set of unit economics. Now, a high performer that we see would create $3 in revenue for every dollar they spend on marketing and SDRs. Their win rates would probably be higher than 20%. They'd be closer to 25 or 30, and they would be creating $10 to $20 in pipeline for every dollar they spend on marketing and SDRs. Which means that on a $10 million budget, they would create $100 million in pipe, all based on the core unit economics of that investment. Same investment, however, a completely different profile between a median or slightly low performer against a high performer. And that is all about the effectiveness of that $10 million in investment. And then I want to break this down a little bit further because CFOs and chief revenue officers are starting to recognize, and hopefully CMOs, that the core issue in their company is that they do not create enough pipeline to be able to achieve the targets, and they don't do it at an efficient way that delivers proper unit economics. That's the core issue in companies today. And so when you go in and analyze this, you can easily see, okay, we create $2 in pipe for every dollar we spend on marketing and SDRs. That's not going to get the job done. We need to be closer to $10. So let's say that, just lay the table with that. We're at $2 return. We need in pipe, we need to get 10 to be considered a high performer or to have proper unit economics across the entire business. So then how do you go and look at the $10 million and try to start to figure out what are we going to do? If you're supposed to be at 10 and you're actually at 2, what that means is that you have a lot of investments that should be at 10 and are actually at 2 or at 1 or at 0. And so what we need to be able to do is use a process to figure out what are the really low performing investments, typically lots of money and low performance, that are pulling down that blended average that should be 10 down to 2. And so if you look at it, let's say the company spends 30% on Google ads and gets a $2 in pipe for every dollar they spend return. And then they spend 40% on events and they get a $3 in pipe to $1 in return. What that means is that the remaining 30% of the budget needs to produce a $22 to $1 return in order for them to hit the objective. So they currently get $2 and $3 in return from their major investments. And then the rest of the shit that they do that's probably not as important now needs to return a $22, $23 return, which is 10 times higher than their existing investments in Google Ads and events. And so in order to resolve this issue, the process is not to go and try to get $22 return with your remaining 30% of the investment. The first objective is to get the Google Ads and the big investments to deliver a much higher ROI than $2 in pipe for every $1 in spend. So you have to go into your biggest performing investments, try to estimate or quantify the current ROI, and then do the things that you need to do to improve the ROI, even if that involves reducing budget, which is a huge thing that I'm pushing right now. As we continue to consult and evaluate with companies, I find that there is a massive benefit in the idea of deletion, the idea of saying, we've done this for 6 years, but we're not doing it anymore. You then no longer spend the money on the program. Your team doesn't get weighed down worrying about planning for whatever that thing is. You don't have reporting cadences around it. You don't have meetings around it. You don't get distracted. It allows you to focus on other things. Companies, especially historically and right now, always focus on addition. We have these 19 things that we do. Let's just put a podcast on top of it, or let's just run connected, $10,000 a month in connected TV ads on top of it. And that's going to make the difference. But consistently in my experience, working with all these companies most recently, the first step is really to delete shit that doesn't make sense anymore or isn't economically viable. Delete or reduce. Reduction works as well, but I think there's a huge value in deletion just for the mental clarity and focus that it creates for your company and your team. And then be able to start creating a plan where basically the ROI of all your marketing investments, it's not an exact science, but it is basically the sum of the ROI of all of your individual investments combined, or the blended average. And so if you have a bunch of high cost investments that do not deliver appropriate ROI, it makes it fundamentally impossible to hit a unit economics target. And so that is a high level explanation as to why marketing leaders need to stop saying, we don't have enough budget was an appropriate thing to say when all that mattered was effectiveness. It didn't matter how much we spent. Most marketers didn't even report on the spend. It was just, we did content syndication and we won 6 deals and we got 180K ARR. And the amount of money that was invested there, or the amount of SDR time or that stuff, wasn't even included in reports in 2018. And now, given where we are, we need to be combining not only is this program effective, but how much did we spend on it? And then what is the estimated ROI of these things? And we need to have not only it generates revenue, but it does it at an appropriate return on investment that's set within the guardrails of our business planning process. And so we need to get out of the idea of I don't have enough budget, and we need to get into the idea of we need to fundamentally improve our unit economics. And if we improve the unit economics, then we would have enough budget. But it's hard to make the complaint, I don't have enough budget in marketing, when we're deploying $10 million and getting 20 million in pipe back, which is going to lead to 4 or 5 million in revenues. We spend 10 million on marketing, we get 4 million in revenue. That doesn't include sales costs and all the other costs. It leads to a unsustainable cost of acquisition and business model. And recognizing that as a marketer, thinking like a finance person or a CEO, recognizing that as a marketer and taking accountability that for B2B companies, from the end of time, from whenever B2B companies started going, definitely for the past decade, that B2B companies have been able to acquire a customer within a specific set of costs, which is typically less than a 24-month CAC payback. And every company was able to do that for a very long period of time. And then all of a sudden, money started flowing in at zero interest rates, and budgets became, valuation multiples grew. In tech specifically, budgets became super inflated. The economy slowed down. And now all of a sudden, just in a 3-year period of time, we've been delivering proper unit economics for decades. the last 3 years has put this whole thing out of whack. And now all of a sudden we demand massive budgets and expect that a 48-month CAC payback period or a 60-month CAC payback period is going to be sustainable. And we've just created a entirely different situation that what maps to the reality of how a business can run. And so we need to get back to core business fundamentals, not only in marketing, but across the entire go-to-market around how do we deploy investments and get an appropriate return that matches the financial goals of the business. That's a message that I'm pushing right now. That is an executive level message that when I was a marketing manager, I thought this way. In 2017, I looked at the quarter. I would go to the quarterly, what do you even call it? When the company has town hall meeting, company has a town hall, CFO's producing the financials. We just finished Q2. Year to date, we've burned $37 million. And I'm like, how the fuck are we burning $37 million on our $40 million company? Like, how can we be so inefficient that we're burning that much money? And it's because we were spending, close to 40 million on sales and marketing on 40 million base. And then you have R&D and HR and administrative and execs and all the other stuff. And all of a sudden, you're burning $40 million. And even as a manager, I was able to look at that and then look down into the sales metrics and the marketing data and say, okay, like we have too many reps. Our per rep performance is too low. We have CS and sales kind of doing the same job. So our costs are doubled. Like sales is getting most of their money from expansion, even though they're supposed to be net new. And then we have a CSAM resource that is gold on usage and expansion, and they're kind of doing the same job. And you just have this big resource inflation. And so taking that mindset at whatever level you are in the organization around understanding core business fundamentals, understanding how that influences and impacts the P&L between gross margin, sales and marketing costs, and all the other G&A, and then what the target profitability is for a company. Those fundamentals lead you to make different decisions if you lead the marketing department. They do. And so that's something that I've been thinking about a lot. I hadn't framed it up that way. When I've talked many times about the complaint about we don't have enough budget is a false complaint. I think it's a toxic narrative that isn't helping anybody. And the clarity around it is it's actually a unit economics problem. And to solve the unit economics problem, we have to go to all our investments, look at the low performing ones, delete or reduce, and then add in much higher performing investments. Another thing that I'll say just to close out is that companies that are facing declining win rates put very large pressure on the unit economics. So if in 2022, you were winning 20% of opportunities, and then currently last quarter, you only won 12%, it just puts that means you have to create almost twice as much pipeline. That means you have to double your marketing ROI in order to just sustain the loss in win rates. And so when you think about where are the places that we can most augment this equation, marketing's usually looking for a new program. They want to launch a TikTok strategy. They want to launch a podcast. They want to, double down on events next year or some marketing investment. But deploying marketing funds to improve win rates from 12% to 15% or 12% to 18% would actually have the biggest impact on marketing ROI, which is a crazy thing to think about. We need to be looking at this across the entire go-to-market. And we need to be thinking about this in more than just creating new programs and trying to drive more pipeline. There's a lot of variables in the equation around what we can do to make an impact here. And so with all of that, hopefully everyone that was here last year knows or last week knows that the internet cut out about 30 minutes into this thing. There was a spectrum outage across all of Texas. So I just dropped off. So hopefully that doesn't happen again this week. And let's get into some questions and discussion. Thanks all for being here.
It was a fun exercise. We kept the event going. David and I took it over. It was great. But we'll get back to our regular scheduled programming. I'm going to bring on Mason. He kind of has a question about what you were referencing.
Yeah, hey, Chris. I'm just curious, as someone who is not super close to the business metrics right now, how did you kind of give that perspective? It's oftentimes something that's, very C-suite, and curious to know, like, obviously there's a very significant case and point to be made in order to have transparency. But what are some of your recommendations to get a little bit closer to that? Like, what have you personally done or seen, like, been successful across individual contributors kind of moving to get that perspective? Just want to hear your thoughts.
I was lucky to work at companies, whether it was a publicly traded company that had to report financials and then they reported at the subsidiary level, so I could see the performance of the company. So that's one. Or that the company had a value around transparency and produced an active financial report in every single quarterly town hall meeting around the performance, cash balance, free cash flow, those types of where the expenses go and how we track to expenses. And that's just about I think that it skews more. I think smaller companies tend to have more transparency, but that's a generalization and probably not totally accurate. And so having the company that just believes in that, I think, is one way. Obviously, you can't change that quickly. Another way is to layer up to the marketing leader and say that, hey, I'm working on these things. Can I get a general idea? I don't want to know what the Southeast regional sales director is making on every year. Like, we don't get that at Passetto either. We get blended headcount expenses. I don't care what one person's making versus another, but can I get a sense about how much we're spending on total marketing and how much this is working over here? I can go into the CRM and know that we closed 72 customers last year and this was the ACV, and then I can start to work on some of these calculations. If you're not able to get it for your specific company, you can still do the exercise with publicly traded companies' P&Ls, just to understand how to look at it. David Spitz is somebody that produces a lot of information and shares that around how he's analyzing in aggregate all the publicly traded SaaS companies. There's 80 of them. So that could be a good reference. And then lastly, I think depending on what your situation is, I think that there's some value potentially in opening up a side hustle, buying QuickBooks for $30 a month, trying to get thousands of dollars in consulting income, writing off your expenses for a coffee with a client or your cell phone bill or your home office expense, and being able to just create your own P&L around your mini business. So you could create a personal P&L. And so those are some ways to increase financial literacy. If your company is not transparent around their own, you don't get such a practical in some of the other ways, but it's a way to continue to build the muscle while you work at a company. Some companies just aren't going to share it at that level. Whether it's a culture thing or for other reasons that executives have decided, or for whatever reason, some companies will not share at that level of transparency down to an individual contributor level. And that's just the way it is sometimes.
Okay, I've got a DM question and it's about planning. And I have one about planning and deletion. So I'll ask the deletion one first as you hit on it. I want to shut down non-brand paid search due to the ROI and ad CAC payback period analysis that my team did. It doesn't make sense in our industry. Maybe it works for others, but it's clear that it's not scalable for us or even currently working. I'm really confident in this move, but everyone, including my peers, are very hesitant. Any advice on how to lead a team through a large transition like this?
It's tough for me to answer this question perfectly without understanding what seat this person is in. Like, it's a very different conversation if you're the CMO versus the paid media manager versus the chief of staff for the CFO.
The VP of demand. So reports into the CMO.
Great. So generally the place to start is with the highest level executive message that you can, because who do you need to get on board with this? You need to get the executives on board with this. If the executives are on board and it becomes a priority and it maps to metrics, then the agency that's running your ads or the paid media will fall in line to what the executives are saying and communicating. So this needs to be a executive level communication about why you're doing this. So first, ideally, you can start with the business metrics. Here's our year-over-year growth trend for the past 6 quarters or for the past 3 years. Here's what our growth has looked like. 2022, we were growing at 40%. 2023, we grew at 21%. 2024, we're planned to grow at 16%. So we have a negative growth rate thing happening. When that maps to new logo business, and here's what it looks like in terms of CAC, then you can take the CAC metric and break it down into marketing CAC. And then from there, you can show that the Google ads, and you can look at the Google ads performance and how that influences the total calculation. And then, so you have to be able to tell a story around, if we want to deliver X in terms of our unit economics, or X in terms of our CAC payback period, or whatever the top level business goal is, then we cannot sustainably do that if we're getting a 60-month advertising CAC payback period on $2 million of non-branded Google ad spend. So you have to be able to show with data that if this is the goal, it is impossible to get to it with this method. Then when it comes to a process of how to stage it out, additionally, you kind of have to know, okay, well, if we opened up $2 million, what are we going to do with it? You kind of have to have a good idea about what you want to do with it. Core recommendations would be to focus on things that influence a sales velocity calculation. It's going to have the highest impact on our overall company ROI. So win rates, cycles, deal sizes, pipeline creation. Those are the 4 metrics you can play with. So you have to figure out, what are we going to do next, or at least have an understanding about, here are the things that are working. Here's what we could pull more gas on. I do not recommend cutting $2 million from Google ads and then going out and doing 10 net new experiments that are unproven. Like, think about how to put that money into places that are already proven to have a much better ROI. Then you need to set up the metrics in a way where this change can be shown as successful. What is the goal of this change? The goal of this change is actually not to create more pipeline, which is what most companies would measure the success of it on. They'd say, we cut $2 million in Google ads and our pipeline production quarter over quarter went down by 5%. That didn't work. We should have gotten more pipeline. Let's go back and spend $2 million on Google ads. But the core metric that you're looking to influence here is the cost per pipeline dollar. How much are we spending to create pipeline, and how much are we getting back? And if that number used to be $2 for every $1 we spent, and now we're able to get that to $3.50 for every $1 we spend, then that efficiency improvement offsets the 5% decline in pipeline and becomes a net positive for the business, because you're going to take that unit economics and run it out for the entire rest of the company, which makes a far larger impact than 1 quarter of missing pipeline. And so setting up the metrics and deciding what is the objective of this change, which doesn't have to be create more pipeline, and then focusing on unit economics and things like that become a core driver. And then lastly, you don't have to just cut everything all at once. You don't have to just say, okay, we used to spend $300K a month and now we're going to spend 0. You can take the lowest performing things that have a CAC payback over X months and cut them, and then run that for a quarter. And then you can look at the data again, and then you can take them and you can cut the next level, and you can stage it out over a 4-quarter period of time, so that you don't just have a big risk or a massive pipeline gap you created through this. And to be clear, if you have $2 million in non-branded Google ad spend that is not producing ROI, then cutting them should not have an impact on pipeline creation. At least not a meaningful impact. If it did, then your ROI would be higher. So those are some things to consider in terms of the process. But so making sure you're aligning on the right goals, making sure you're telling an executive level story around why this is important that matches the business context. I think it's one of the values of Passetto recently, spending a lot of time with CFOs, is that before we ever do a marketing analysis, we understand what the company's growth rate is, what they planned on growing, whether they're ahead of plan or behind plan, how they feel about 2025, what their unit economics are, what they need the unit economics to be next year, what the CRO is saying around the declining win rates. When you have all of that context, doing a marketing analysis becomes far more productive. You're focused on solving the business goals through the marketing budget. And so I think that whenever you're trying to do something like this, if you're a VP of demand, you should be able to at least get some of that context so that when you are crafting your strategy, you can map it back to what the CFO and the other executives are really caring about for not only the rest of this year, but into 2025. Like, we're doing consulting with companies right now, and they're like, we're behind our 2024 plan. There's 5 months left in the year. You have a 90-day sales cycle. Nothing you put in place right now it's going to take you a month to plan it, months to launch it. By the time you even get it in market, it's not going to make an impact on pipeline this year. And so what do you need to be doing over the next 5 months? Do the best you can. Try to improve win rates, try to augment active pipeline, try and improve efficiency, and get yourself set up in December. So when you put together a 2025 plan, you know you're going to hit the plan. You know that you have the programs in place to do it. You know you have the unit economics in the right spot. And it's about making sure that you don't sell out for 2024 by putting a bunch of random stuff in place to try and hit the plan and then leave yourself high and dry for next year.
Awesome. We're going to go to a live follow-up question next, but this was also a DM question, very relevant to your last comment there. They're in the middle of H2 planning and they're curious of how do you balance investment allocation for 2024 pipe while putting dollars in market for supporting 2025 H2. What expectations do you set for those investments with the executive team? And what's your point of view on that?
Typically, when you think about what are we going to do to create pipeline for 2025, inside of a company's data, they don't know. The pipeline, they don't know what creates a lot of pipeline. They know how they can capture in-market accounts with Google Ads or SEO or lead gen or intent data. They know how they can get an in-market account into their pipeline, but they don't have a good sense about what is actually getting that account in market. They don't have a proven way. They don't have the measurement set up to look at that, and they don't have the data to support what is working and what is not. To set up that stuff for 2025, we need to run experiments now. We need to measure them in the right way. We need to be able to collect enough data over the next 6 months so that we have a clear strategy around how to get net new accounts in market by the end of this year, so that we can then put fuel on the fire about the things that are working going into 2025 as a way to create, when we have 12 months of runway to create and close pipeline into 2025, you have a lot more runway than the 5 months you're playing with at the end of this year, especially depending on your sales cycle. And then the places where you focus in order to make the biggest impact in 2024 is in sales velocity metrics. So think win rate, opportunity win rates, conversion optimization. Like companies have hundreds of thousands, if not millions, in net new ARR sitting in a shitty process between someone that's qualified filling out a demo and that person becoming a customer. The conversion rates make no sense. For every 100 qualified people that go and fill out that form, most companies are going to win 2 of those people. 2 out of 100 that is a qualified person that asked for a demo. And so why could we not I don't know why that isn't the number one priority for RevOps or a top priority for a marketing ops team to get that number from 2% to 7%. And then every single other dollar we spend on advertising or Google Ads now works 2.5 times better or 3.5 times better because the conversion rate is so much more effective. And so focusing on conversion improvements, whether that's opportunity win rates across the board through pipeline marketing, in-person events, other things that you can do there, improving website conversion and the conversion that then has those people move into a meeting and so forth can be a way that you impact revenue this year with only 5 or 6 months left in the year. And then after that, when you think about demand capture and lead gen programs, to me, that's all about improving unit economics and efficiency right now. Like, it's not necessarily about how do we spend more money on Google Ads in order to get 6 more meetings next month. It's about how do we get Google Ads unit economics in a place that is going to be sustainable for our 2025 plan, which then leads back to reduction and deletion as the main strategy, not by adding more keywords or spending $10,000 on an agency to build a new landing page.
Love that advice. We are going to bring on, let me just unmute him real quick. Kyle.
Thank you. I just asked kind of similar in line with Mason, and I appreciate the time here and being able to join the call. I have the context about larger company and also very siloed business divisions at the moment, with 2 teams in US with multiple business units under each team, and then multiple teams in different countries in Europe with similar setups that are almost autonomous by design from leadership. Just trying to influence some of the metrics that we're looking at from my seat, which is I was put in a go-to-market leadership role last fall, right? But it's within another silo, which is in our software division. So I guess I'm just not sure exactly the question, Chris, but just
Yeah.
how to start to get leadership to look at, different metrics and different things that maybe they're not even thinking about, not measuring today.
What is the scope of your role? I'm more so curious.
Yeah. So we are like a VAR. And so we resell third-party software, and then also offer consulting services around that. My role is inside of our own software division, where we develop, additional value add tools. And my success metric is around increasing the ARR around those tools. So it's part of our global strategy, but it's just one piece of a thing we sell. And that's also a challenge, is people's priorities, right? They're like, yes, this is important for our strategic initiatives, but we also want to sell these other 20 things that we do over here, and we don't have time sometimes. So
Yeah. Who do you report into?
I report to our CTO. So so he oversees the entire P&L for that software division.
Got it. Does he also own the revenue target, or do you have a sales leader or someone else that owns the ARR target?
He owns the target for his division, and then each of the country units sort of have a similar, portion of that number that they own.
So a couple caveats here, like whether it's getting the visibility into, potentially confidential financial metrics, or getting people to buy into a new way of looking at data, totally direct. There is a level in the organization where you can get those things done, and there's a level where you usually can't. And
Yep.
so part of it is just acknowledging that. I tried to make so many changes when I was a manager and a director, and while I made progress and learned a bunch of things, it never was implemented in the way that would have made sense if I was the CEO or an executive driving those changes. It's just not even close. It didn't happen at the speed. There was a lot of speed bumps to like stop and look at data when it didn't even need to make sense, and then waiting for approvals and, conditional budget releases and all this other stuff. So that's just an acknowledgement, like, to realize where you sit in the organization, where your level of influence is, who can be your helpers that are higher than you in the organization, whether it's your boss or your boss's boss's boss.
And frankly, the CEO put me in this role, so I have his ear. It's the influencing, and again, it's somewhat by design. The company is acquired, grown somewhat through acquisition, and they give the acquisition companies a bit more freedom that maybe is actually beneficial. So I have his ear, but then it's like, okay, we need to get alignment from all these different business unit leaders. So there's probably 20, 30 executives that, are running this way. And, what we have to say maybe isn't as important to them because they don't have the pressure top down to really change what they're doing, except hit your number, right?
Do you all use one centralized CRM to manage all this?
Nope.
Yeah, I mean, you're only going to get so far then.
Yeah.
Yeah, like especially with like the grow by M&A and then have them operate independently. Like every single independent one is using their own CRM with their own data. There's no roll up or visibility outside of core financial metrics. You're basically flying blind here.
Yep.
And
There are
it's like
three separate CRMs at the moment.
And then it's just oftentimes not the most important thing in the business to stop and waste a year to consolidate the CRM into one tool. It's just there's benefit to it, but it's a huge administrative burden. You have to retrain all the people depending on the size of the company. Like it creates a lot of problems. And so while there's a big benefit in having consolidated data, it's not always the right move for a company at that time. So I don't think consolidating CRMs is the move. And so with that, you have like the option to try to stitch the data together. You have the option to focus and prove it in one unit, which might be the recommendation from me. One company, they use the CRM, go in there, make changes to the data, collect the KPIs in the background, see if you can backtrack and retroactively backfill data that already exists, set up the like core metrics that you want to measure and what the trends are, and then demonstrate that those metrics are more positively correlated with business outcomes than the existing metrics that are used. So that could be like one way of getting it done, given the like immense headwinds that you're facing in terms of like the organizational design.
Yeah, no, I appreciate that. And thankfully there is a project underway to the two US companies are kind of converging over the next 18 months into a single CRM and into one working group. So there's long-term benefit there, but I do see like the opportunity just to go to the CFO who I have a relationship because I was part of that leadership team and as a VP of marketing before. So it's like I could go back to him and say, hey, let's sit down and look at some of the things you're talking about around the budget and where we are against actuals and the costs and stuff like that. I think that's a place to start and not try to save the world in a sense. So I appreciate that.
Cool. Thanks for being here. Appreciate the question.
Okay, we have another one. It was actually submitted last week in the technical difficulty episode. This is from Lynn. She asks, I'm setting up an end-to-end go-to-market infrastructure for the entire customer journey of a profitable startup that has to constrain versus strain for growth. What metrics should I suggest to measure my efforts?
So I'm gonna answer this question in two different ways. The first way, and this is not necessarily a direct answer, but it's more just for everyone to understand how I see this point, is that consistently when you have an in-house operations team that is tasked with building out this type of solution or something like that, while it feels like a straightforward operations project, what you're asking these people to do is really do a product development project. You are asking these people to reinvent the wheel and to come up with a solution of what should the name of every property be? Should it be on the account or the lead? What are all the automation flows that are going to push the data? How are we going to connect all these tools in? What data is flowing in? What data is flowing out? And you're requiring these people to go through and do something that they've never done before with no roadmap or no destination for what does the end look like. And so when you build it out, you build out things in one direction, and then all of a sudden, because you didn't have a map, you didn't take that turn, now you're starting to build stuff in a whole different direction. And then all of a sudden, you're 50 million ARR, just like many of our customers. You don't have the right data to make informed decisions, and it's going to take you a year to unwind all of the stuff that has happened up to this point. And so, to be clear, the actual issue with these things is that there is no roadmap, there is no architecture for what you're building to and how to build toward it. And so that's the issue. It applies to every single company that tries to run operations in-house, is that while winning by design has a nice bow tie framework, and while demand waterfall from serious decisions has a nice little framework, there is no consistent architecture around how do you collect the data, what objects do you collect it on, how does the automation work, what are we building towards, what does the end look like? And so when you think about this, the number one thing that you want to solve for, at least when you think about it in the long term, is what is the actual desired outcome that we're trying to get to in 3 years? What does it look like? Why does it look that way? How are we able to report? What are the capabilities and things like that? If you cannot produce that picture, it is unlikely that the things that you're building toward are actually going to layer up to something more meaningful in the long term. So, root issue in operations and data in companies: no architecture, no roadmap. When it comes to you specifically, there's many companies that will hack it together on their own and be able to get good enough for a while and then run into some level of tech debt down the road. And at startups, many people will choose that path because at the beginning, the pain isn't so high. And then over time, the pain just gets larger and larger and as you get bigger. And then depending on, like, I'm consulting with a company right now, they're 2 million ARR. We're doing that at Passetto. And like our recommendation is go deal, but like they only have 40 deals in pipeline. They sell a high ACV, low volume product. Like, why are we building attribution and automation for 40 deals? Like, go manually deal by deal and review the data and develop your own conclusion around what happened with the deal rather than relying on software that's built for high volume touch points. And so depending on the amount of deal volume would also lead you to how you're going to build the solution. I, at Passetto, and Winning by Design has published something similar, but I see it a little bit differently as I've thought through this problem more. You basically need a metric stack. You need the stack that starts with the top level metrics that you're reporting to the board: growth rate, sales and marketing percent of net new ARR, free cash flow, rule of 40, things like that. Then you have financial metrics like your total ARR, how that breaks down to new logo versus expansion, what your CAC is, things like that. Then you're breaking it down lower. And all of a sudden now you have what is the return on our marketing and SDRs against pipeline creation, and our sales team and how they're closing, and PRP ratios and quota attainment and all these different sales metrics. And then you have the post-sale, and you have NRR, churn, expansion, all that data. Then you can break it down into the unit economics of those core processes. Then you can look at every investment underneath those processes, and you can literally start at the top and break it all the way down to see where are the issues in our go-to-market engine holistically that start with financial metrics and work their way down to CRM metrics. That's what a $100 million ARR company needs when they get to that stage. Is your early stage startup, do they need that right now? Probably not. But that is the roadmap in which you can work toward, and we'll be working on defining that a little bit more so that as you build, you know what you're building toward. That's been a new insight for me recently, because many people are like, we have a RevOps team, we'll just have them do the project. And the reality is that those people do not have an architecture. They've never done it before. It's going to take 10 times longer. And then oftentimes the crazy thing is once they actually do the work and it takes 10 times longer, it doesn't even get used. There's a lot of RevOps projects that then come to fruition, take a long time, and then literally the organizational change never happens and all that work was for nothing. As we continue to dig in, I'm consistently surprised between what people are cheering about, and I'm not here to tear down RevOps. It's definitely not what I'm doing, but the sentiment that you hear from people about how important RevOps is, that some people say it's the most important function in the company right now versus what that function actually does for the company. And it's just very different than what people are promoting it as versus what's happening in real life. I think a lot of that is architecture based. I think a lot of that is pride and ego around wanting to be able to do it all yourself. So I just see some opportunity there for that function to continue to level up and deliver on the promise. All right, Sydney, maybe one or two more.
Yes, we've got one more. This is from Carlton. I'm going to read it because he's playing double Zooms. He's actually on another call and listening to this at the same time. So
hell yeah.
Love that for you, Carl. Okay, we've been attending large industry events at a startup level cost, but next year we no longer qualify for those discounts. Prices ultimately triple. Example, going from 20K to 60K for a minimum investment in these events. I've yet to see hard sales correlation between our previous event investments, and we're getting pressure to continue pursuing these events. What are your latest thoughts on the brand impact and brand argument for attending large, expensive conferences for startups?
Literally zero value. Zero. You think that everyone that attends that conference is going to carefully walk through the big booth and see your 10 by 20 sitting in the backhand corner that no one walks by, and that's going to make such an impact on your brand for 60 grand. It's a made up metric. It's a made up benefit from the late 2000s into the early 2010s, where there was no internet, barely any websites, and the only place you discovered things was at the annual conference that you went to get continuing education credits and see your peers and friends. That's where that sentiment has come from. Posting literally one podcast a month or posting on LinkedIn one time a month would have a bigger impact on your brand than building a booth at a conference at a much lower ROI. And so when we think about the brand impact, we not only have to try to justify the conference expenditure with it, but we need to look at what are all of the other available ways that we could impact our brand perception or our brand awareness in our market that don't cost $60,000 to build a booth for 3 days. And there are infinite options that would be more effective against the cost to create brand awareness or improve brand perception than building a booth at a conference. And so we just need to look at this objectively right now. That benefit is an assumption. It is not measured by companies. I watched how companies report on that. They report that it impacts brand. They never measure anything about it. And it's a philosophical argument to justify that we keep doing the things that we've been doing over time, regardless of the ROI. That's what it is. And so I think we need to be looking at, we could spend the $60,000 times 10 conferences. We could drop $600,000 on booth expenditures. Then you have all the T&E and the planning costs and the headcount costs. And now all of a sudden we're at $1.5 million that we spend on these 6 trade shows or 10 trade shows. Or we could deploy that $1.5 million in this different way. If the goal is to build our brand, that you would, if you ignored what you did in the past and you built a new plan with the same budget against how to build your brand with the money available, you would come up with a much different, much better plan on how to do it than to build 10 trade show booths next year.
Mic drop. Okay. That chat was blowing up with some support there. He's a regular that comes to the show, so they do a lot of content production and a lot of content as well. And one of the things in the chat brought up about sending attendees versus sponsoring a booth, but it might just be something that you want to put in the deletion category of events. Maybe that's the deletion for this next year that you're going to not do.
And then if you ignore this element of okay, we're going to create these second order assumed metrics about the impact of our conference booth expenditures. So even though we spent $60,000 and we created $100K in pipe and we won, all those moved to closed loss, we spent $60,000, we won 0 deals. This isn't a positive ROI. And then we try to justify it by, well, there was 5,000 people at the conference and maybe 10% of them walked by our booth. So, on a cost per touch basis, we influenced one, for $100 per person, and it's all just made up math. And instead of doing that, just justifying it on direct ROI. That's what a booth should be scrutinized against. We are building a booth to create pipeline, whether that's with new customers or existing customers. That's why we have a booth. They're going to walk by, they're going to learn about the product. We're going to try to convert them into a meeting. We're going to tell them about the new stuff that we have. If they're a current customer, we're going to talk about the new products and how they can cross-sell or expand or get a new department involved or more seats or whatever. We are trying to create pipeline. And then from that pipeline, it will move to won or lost. And we can look at how much pipeline we created. We can look at the win rates and we can look at how much we won or lost. And then you can stack that up and say, we spent $60,000 and we got 0 in, and we got 100 in pipe and 0 in revenue. This was not a good investment. Or we spent $60,000 and we got $1 million in pipe and we got 600 in closed won revenue. This was a great investment. And the same booth expense and the same thing just predicated on ROI could have a very high ROI that you should keep doing it every year, or most often a very low ROI where you should stop doing it. And it is, to be clear, it is not about the cost. The cost is one element of it, but it's not the only thing. If I told you, so some people will push back on Passetto on the cost per hour, right? So they're like, oh, well, a normal consultant would be, we think $250 an hour, that's what we'll pay you. And at Passetto, we charge closer to $750 an hour. And what does it matter if you pay $750 an hour if every hour we deliver, you get $10,000 back? Would you take, if I said, pay me $750 for an hour and then you get $10,000 back, everyone would take that and they would keep doing it. And that's just an easy example. You could do the same exact thing with a conference expense. If you spend $60,000 and you get $600,000 back, let's go find more of them. Let's do more of them. But it just doesn't turn out that way in analysis that we do for most physical events right now. And maybe it did 10 years ago, but we need to stop trying to justify with these made up mathematical metrics like cost per person influenced, or, cost per booth attendee, or impact on brand awareness. It doesn't even have a metric attached to it. And if you're going to build a booth, it should be looked at direct ROI against pipeline, because that's the only reason to have a booth that you couldn't get done just by attending the conference and walking the show.
Well, that answered a follow-up question, which was, how should you measure events? I'm squeezing Alex in. He's a regular. He's coming
Let's
in
go.
for a last question to send us off.
All right. Hey, Chris. So I have a question, because I had a talk last week with a CEO who has like a manufacturing company. It's like a $30 million revenue per year average. They have like a 9% growth year over year. They invest, in terms of marketing and sales that represent maybe like 5%. So in terms of numbers, it's like really sales-led growth business. So they don't really actually have they have 3% in marketing, but they don't really have like a strategy or programs or anything like it, And I was kind of wondering, like, when you're starting from scratch, where you have like this mature sales organization and you want to build this marketing angle to it, you have like two ways where you can really create value, in my point of view. Like, for the reality is whether they really help optimize the pipeline conversion, because in terms of like account expansion, there's like a lot of opportunity there where they could really create value for the sales team to really close faster deals and like create more value in the process, or really create new pipeline overall. And we had like this discussion where she was like, I'm not sure what terms of KPIs or where I should like put the measures on the marketing team. And I just want to like exchange on it and just hear your thoughts. Maybe if it could be really helpful, actually.
Yeah. So I've worked in these companies many times. So I totally understand the $30 million company that has 4 people in marketing, when a $30 million SaaS company might have 25 people in marketing, right? The reason is because manufacturing companies, not all of them, but many of them, just have significantly lower gross margin profiles, or they have to sell through distribution and they give 35 to 50 points to a distributor. And so they start with 80% margin from their cost of goods against the sale price, but then they give away half of it to their distributor. And all of a sudden they're left with 35, 40 points before they pay anyone. So that's the difference between a manufacturing company and a software company that sells with direct sales, and why you're only seeing 5% on. And I find that hard to believe, to be honest. 5% of 30 million is 600 grand
for marketing, like but like in terms of overall, like they spend around like 1.5 million, I would say, in terms of if you include sales. So it's really like it's like a small tiny amount, because they don't invest much in terms of like entering like opening new boutiques for distribution. They manage to open fast, but their challenge is to gain more wallet share within these accounts, to gain more expansion and open and gain expansion in new territories also. But so they have like low expenses on this side, but like in terms of marketing, it's like an open book. Like there's nothing there yet, So they've tried a few things for sure. And it's really organic. It's like, there's like this big event, so we'll try this, but there's like no clear strategy on it. So the first thing we had, like in terms of discussion, was to first structure like the pipeline, the infrastructure of like, okay, like what are the stages and where marketing can create value in those stages. But I was kind of curious to hear your thoughts, on where you should like work first when there's like nothing there yet, actually. And it's really like mature in terms of sales, but there's nothing in terms of marketing.
Yeah. And specifically, it sounds like sales is really more account management.
Yeah.
Right.
Exactly. They call themselves reps, but it's 100% account management. There's like no AE there. It's like there's not really a lot of net new developed, really, actually, and that's an issue also, for sure.
Yeah, if you're only growing 9% and that your quota and your OT are based on that, why would you go out and hunt when you can arguably get there with just feeding off of the existing customer base? The sales team is not incentivized to go do the hard work to get a new customer that's going to pay less on the first deal, take way longer to close, win 2, 5, 10x less than they would a deal with a current customer. So it's just incentivizing the sales team to go after expanding current customers and managing current customers because it's the path of least resistance. If you had a 40% growth target instead of a 9% growth target, it would fundamentally change how you would invest and what you would do, because the sales team just would never get there and they wouldn't hit quota around it. Arguably, it would be unrealistic as well. But a $30 million company growing at 9%, it's just not a very impressive trajectory. There leaves a lot to be desired. Let's put it that way. And then when you think about the investment here, it's just like, what can you really do with 600 grand in marketing and you have 3 people? Like, let's say you have 300 grand tied up in half the money tied up in headcount. You have 300 grand per year, which is 30K a month across to try and impact the growth. What are you left with? You have like the ability to run like a small level of media. You could build a retargeting flow on LinkedIn ads, Meta, potentially like a YouTube or something like that, depending on what you have. And you could spend $3,000 to $5,000 a month and have that flow. And then you're pretty much forced into an organic thought leadership strategy. You're forced, because of the budget constraints, you're forced into, let's interview all of our happy customers. Let's interview all of the thought leaders in the industry. Let's have our, head of product development talk about the new release that we have. Let's then take that and put it on social and send it out in email and put it on our website and put it on YouTube. And that's basically all you can do with that sum of money. And it's an incredible strategy for your size. Like, if you know your target customer well and you can do that strategy, like that would have the largest potential impact with one of the lowest investments. So that would be a great strategy to run. It's just a lot of companies don't do it well. But just based on the existing constraints, it's like all you can do. Like, what? Are you going to buy, like, go and hire some random SEO agency for $8K a month and hope that in 9 months you have more traffic? Like, I wouldn't make that bet with 30% of my remaining budget. Like, basically convince the company that they need to be able to spend more on sales and marketing, and then be able to open up availability of other things. You can't do physical events. You can't do micros. It's all virtual, all digital at that spend level. And then it's a modeling exercise to understand what amount of new customers do we need to get, because at some point you're just going to reach a point of saturation with your existing base. You're not going to be able to expand them anymore. They're not going to buy more unless they're like, basically your revenue is in line with their growth. Think you sell like a chip for the iPhone. Like, if the iPhone sells more sales, that means you sell more chips. Like that, if that's the business model, then potentially you're in a fine spot. But oftentimes your customers, especially in these industries, are going to hit a point where they don't buy anymore. They hit a max, and then oftentimes it's the maturity curve. They actually start declining. And if you don't have new customers that are currently expanding, it doesn't offset that, and you will reach a point of revenue decline. So figuring out a strategy to acquire net new customers and using marketing dollars in order to do that, not sales resources, is the move. It's just about figuring out how to set it up with a budget and a strategy and a time frame that makes sense. Given it's a clean slate, it's like, ideally the situation is great because you don't have somebody breathing down your neck about how do we create more leads for our sales team next month. You don't have that pressure. It allows you to focus on different things. Another thing that I'll say, it's probably not relevant, but there are many manufacturing companies that should be acquiring a net new customer through an e-commerce transaction, not a sales transaction. And they should get the product in the hands of people in a self-service way, just like SaaS does it in PLG, because the first deal in a lot of manufacturing companies is a $2,000 sample purchase, or like a small purchase where that person might buy it, never use it, or use it, and then they're coming back and they're buying a $50,000 purchase next time. They want to talk to a sales rep and they want to customize it. And so getting that first transaction self-service repeatable, instead of having a sales rep spend 70 days to sell a $2,000 deal, like, those are some of the examples around new customer acquisition in manufacturing that I think would be innovative strategies. Cool. We did block off a little extra time, so we are able to go 7 minutes over this time. So thanks for the people that stick around. Hope you enjoyed this episode. It'll be published on the podcast on either Friday or next Tuesday, so stay on the lookout for that. And we will be back here again same time next Tuesday. Hope you all have a great rest of your week, and we'll see you again sometime soon.